Okay, let's look at another example, but this time instead of looking at accounts receivable, let's look at accounts payable. As you well know, accounts receivable is an asset account. It's basically a claim that we're going to collect something in the next 30 days. Accounts payable is the inverse, is we're going to pay something out in the next 30 days. So let's focus on 22 here. Ugh, this mouse has gone wild. Uh, So we had Yellow Company, and it had a balance of $33,000 in accounts payable at the beginning of June. Looks very familiar, similar like the other one, right? And they purchased 101,000 of merchandise on account during the month. At the end of June, Yellow's accounts payable balance was 29,000. What amount did Yellow pay on account during June? This is a classic, once again, 3-4. Given three elements, you have to solve for the fourth. So the first thing we have to ask ourselves is, accounts payable, where does it fit in our scheme of the accounting equation? Is it an asset? Is it a liability? Is it owner's equity? Well, I mean, it's not an asset. When you have a payable, when you owe the outside world money, that's not a good for you. That's going to be a liability, okay? So it's not an asset like accounts receivable. Accounts receivable is an asset because we expect to collect that in the next 30 days. Cash is coming towards our company. Okay, this is the opposite. Accounts payable is cash going away from your company, right, in the next 30 days. So it's not an asset, it's a liability. Well, liabilities, if you look here, have a normal credit balance, right? They go up with the credit, they go down with the debit. You notice that what makes the asset, liability, or owner's equity go up, whether it's debit, credit, is its normal balance. It's what you would expect to see in that account. So accounts payable here has a balance of $33,000 at the beginning of the cycle. So you fill that in quickly. And then it tells you that at the end of the cycle, notice how we're ignoring the middle for now, you have 29,000. Notice also the exact opposite of accounts receivable, which were on the debit side. Then it says they purchased 101,000 of merchandise on account, so purchased on accounts payable, right? Just like received. See, sales on accounts receivable. Sales, when you sell stuff, cash comes towards your company. Merchandise on accounts payable during the month, that means money's going the other way because it's a payable, is 101,000. Okay, so if you purchase this merchandise, right, you have more merchandise. And merchandise inventory is an asset. Assets go up with a debit, so we'll put 101,000 here. That's the debit. And then the credit is 101,000 in newly owed amounts over the next 30 days. So in the next 30 days, we've purchased this merchandise, and we expect to pay the outside world this over the next 30 days. And that's basically pretty much it. All you've really got left now is to back into what this is, because you've been given the three and you put them in the correct place. You got the beginning, ending balance, you got the ending balance in accounts payable, and then you correctly identified that when you purchase merchandise on account during the month, you have more merchandise. So there's your debit to the asset. Here's your credit to the liability. Remember, assets, both sides of this equal sign have to be equal, obviously. So basically now you're just backing into, if you take beginning balance plus the additional merchandise inventory purchase on payable, on accounts payable through the cycle, and subtract the ending balance, you back into 105,000. So 105,000 had to be, let me see, what Yellow paid on account during June. So just to show you both sides of this, when you paid on account and your accounts payable liability went down, remember liabilities go down with a debit, here's a debit, this would be the offsetting entry, cash for 105,000. I just have these other accounts so you can see both sides of it. So there's the credit that goes with that debit. Began with 33, ended up at 29, bought an additional 101,000 on 30-day credit. That's what accounts payable is. And then you have your cash transactions, the cash collections, because if you have any, excuse me, not collection, the cash amount you pay on accounts payable. So there's cash going down, and likewise, here's the liability account, the accounts payable liability account, also going down. Remember that liabilities go down with a debit. This is how you back into this. The reason I wanted to show you these back to back is you will carefully notice that everything here with accounts receivable was kind of backwards. Accounts receivable is an asset, so it has a natural debit balance, and then you have different transactions that get you to the ending balance. Accounts payable is a liability. It's a 30-day liability, and it starts with credits and then has entries in the middle that help get you to your ending balance. So anyway, you got an example of accounts receivable and accounts payable now. I hope you found this useful.